Does it feel like the stock market is just a roller coaster? One day we're up 200 points and then the next we're down 400? Because if you think it does, you are absolutely correct. Just over the last 3 weeks, we were at market highs of 32,000 for the Dow Jones. And then over the course of a week and a half, we dropped almost 2,000 points. And then on the start of Monday, March 1st, we're up 600 points. Tuesday through Thursday, we're down, and then on Friday again, we're up over 550 points. That is just the last couple weeks for the stock market. Most average investors have heard the term time the market, and that sounds like a fantastic idea. You sell at the top, you buy at the bottom, and you're just raking in these huge profits over and over again. But for the average investor who doesn't follow the stock market closely, the really big gains and dips might seem very sporadic. So here are 3 reasons why you can't time the market. First, you don't have an edge against the pros. One of the biggest reasons is that you have no advantage against the professional traders. In today's day and age, with supercomputers and complex algorithms, it has never been easier for retail traders to invest into the stock market. As a result, it's harder to find opportunities where you can buy the dip and sell at the high point if you are not a professional or doing this every single day. There are many professionals out there who went to school and have poured in thousands of hours into reading charts and finding the next biggest plays. They have the knowledge, the know-how, and the professional setup that would make your iPad or computer when you're stock trading look like you were playing t-ball against professional baseball players. And this ties directly into my second point. You need to be a full-time investor. Most of us have a full-time job that is not related to the stock market, which means the majority of us are classified as hobby or retirement investors. If you're a hobby investor, that means you have to take time out of your day, your free time, after work and all of your other obligations are done, to research stocks or different companies to figure out what you want to invest in. And if you're a retirement investor, that means you're just strictly investing into your company's 401k and your Roth or traditional IRA, and you're not thinking about anything else. Professional investors live, breathe, eat, and sleep the stock market every single day. They research the market's performance, different company headlines to make educated decisions on which companies will be increasing or decreasing in the following weeks, months, or years to come. So basically it comes down to this. If you're expecting full-time results with a part-time effort, you're going to be extremely disappointed when investing in the stock market. Third, market timing can be extremely stressful. Most traders will succumb to their emotions. If the market rallies up hundreds of points, most investors will not want to miss the climb up and they will FOMO into that rally. But when the market ends up correcting down, most average investors will either end up panic selling to cut their losses or take whatever profits they can with their investments. It is difficult for a lot of traders to control their emotions in the stock market. It takes a lot of time, effort, and training, and to do a lot of due diligence on the stock you're going to buy and hold for whatever time period you're going to trade it. Professional traders do a lot of research on the different stocks or companies they're going to invest into. They have different price targets or different entries and exit points that they want on the certain companies that they buy. But if you're an average everyday trader, most likely you do not have certain price points or certain triggers to when you are going to enter and exit a stock. These few combinations are just a few reasons why timing the market is just not possible. Lastly, the future is truly unpredictable. Many people might sit on the sidelines as they see their index or a certain stock reaching all-time highs. They might not buy that index or that stock because they think the market is too expensive. Or when that might drop, they might not buy that stock because they're waiting for that stock or that index to get even lower. As a personal example for myself, during the COVID crash, I wanted the market to drop another 5%, and I thought that it was going to, but I didn't, so I missed out on some of the beginning points of the rally. And it's only months or years later where we can see the market peaks and valleys through a particular cycle. Hindsight is 20/20, and you can't recover lost potential earnings because your cash is sitting on the sidelines due to fear. A Merrill Edge study compared hypothetical returns of investing $1,000 into the S&P 500 from 2009 to 2018. So in this study, if you invested that $1,000 for the entire 2009 to 2018 time frame, you would have come out to have $3,530. But if you missed just the 10 best performing months in that decade time frame, you would have had $1,580, a significant decrease if you were just invested in the stock market the entire time. Now, if you would have missed just the 20 best months of that decade time frame, you would have actually ended up with $958. You would have had less money than the original $1,000 invested if you missed the 20 best performing months in that decade time frame. Guessing what the good months will be ahead of time is nearly impossible, even if you have the best algorithms in the latest research. Plus, there is no accounting for any political change, company change, or world event that might happen. There is absolutely no way you can predict the future. The general population doesn't even know what they're going to be having for dinner next week. Is it going to be pizza, pasta, hamburgers? Hell, I don't know. Do you? So if you don't even know that, how could you even expect to know what's going to happen in the stock market next week or the future to come? Just because you can't time the market doesn't mean that you shouldn't be investing. As that Merrill Edge study went over, if you just invest your money for the long term and you ride out the highs and the lows, you will come out ahead. The easiest thing for any average investor to do is to invest into an index fund consistently. Something like VTI or VOO that's just going to track the stock market S&P 500 or the total stock market and let it ride. Doing that will guarantee that you don't miss out on any of the massive gains, but also that you're holding through the major dips. And if you're consistently averaging into your position, every time you get paid, you can ride through those dips and those gains and you'll end up ahead in the long term. And doing that will give you consistent growth in your portfolio. If you liked this video or learned anything, please just tap that thumbs up button for me, subscribe below for more content, and leave me a comment on how you plan to not time the market. And until then, I'll see you in the next video.